It's Rick here. After several days off because of computer problems, which now hopefully, touch wood, are behind me, I'm back in business again. Starting with our risk model, nothing changed, everything solidly in the red. Today's action, everything down just modestly, small caps, quarter of a point. Mid caps about 0.5%. Qs were about break even. SPY down 0.32 and Toronto down 0.1. So not a big decline today. But let's just take a look at the charts. Starting with the small caps, IWM, still in this decided downtrend. Doesn't look any better on the weekly. No real change there. We still have yet to take out these lows from September the 27th. So we're still hanging in above that. Mid caps, same story. They're even actually a little bit stronger. The low set on the 27th is still looks like about 5% or so away. So a ways to go there. Qs have set a new low. These are some lines I drew earlier. I think I said last week, if we go above here, it's going to be systems go. If we did trigger, our stop would be below here. Well, it never triggered, obviously, and traded right below it and just kept on going lower. So I can take all of these drawing tools off and we'll start again. So it's at new lows. I mean, we're due for a bounce, but don't know when we're going to get it. And the S&P just has barely snuck below the low. So a new low has been set. And even Toronto was holding up here and then got slammed in the last couple of days. And so now it's set a new low. So there is nothing to do. I'm going to go down a bit of a path here with looking at historically what's happened with the S&P. I was looking on the weekend thinking, well, this year's definitely going to end the year down. And I wonder how many years in the past 50, 60 years or so have we had 2 or more consecutive years down. And so I'm going to do a little review of that in a second. Just a quick update on my positions. Obviously, I got stopped out on most of them. ARPL got stopped out for a small loss. For solar, which I should never have taken, I think I mentioned that, got stopped out again for a small loss. HQY, again, was a bad entry, poor entry, let me put it that way. And I got shaken out here on this bar right here, and then it ripped right back up again. And I didn't rebuy it. I just don't have didn't have the confidence. So sort of missed that one. UNM entered last Friday, I believe it was, still hanging in there. I got about $1 gain out of it, but it didn't sell anything, and now took half off it, my break-even stop, and I got the other half stop just under today's low. So it'll be a tiny loss if that gets stopped out tomorrow. NOC was a big disappointment. I was in down here at 485 on this downtrend line break. I recall saying if it took out 497, I might add back the bit that I sold. I didn't, and I didn't sell any on this move back up here on the last couple of days. And then look what happened today. This, in a good environment, this just should not happen. That's just acting abnormally. And so I got stopped out on a trail stop on a quarter, and then the remaining half here. So, I mean, overall made 2R, twice what I risked, but at one time I was up almost 4R, so a little disappointing there. And the one that's holding up is Twinkie, Hostess Brands, maker of Twinkies. I'm in down here at 23.75. I added to the position today when it took out 24.26, which was the high of this base right here. And it's so far it's performing well. But again, this is such a tough market. But this is a classic pattern, which I won't go into explaining now, but when I do my tutorial on what to buy, when to buy, the patterns I'm looking for, this one is a classic. It will go in my so-called model book. Back to what I wanted to talk about mainly was, if you do a Google search and look at the historical returns from the S&P, this goes back, I think, almost 100 years. Goes back to 1928. And so, I mean, I don't think any of us were born then, but the Great Depression, we had 4 consecutive years of negative returns. And look what happened when we came out of it, 46% gain, and then slipped back into a loss, and then more gains. And then it took until 1939, the beginning of World War II, I guess, when we had 3 consecutive years of declines, and they seemed to be escalating, and then came out the other side with 4 pretty good up years. And then again, and after the war, these were really break-even years. So for 3 years, you lost some here the first year, and then didn't make anything back for 2 more years. And then it ripped pretty good. And then since then, the losses have been contained to 1 year, with one exception as we get up to 1973, 17%, and then almost 30% the next year. So that was not pretty. And then we go all the way up to 2000, the tech bubble, when it lost 10%, then 13%, and then 23%. But then came ripping out the other side with 26. So, and then since then, it's only been 1 year losses, although there was a really big one in 2008, 38%. Oops, wrong way. And then since then, it's, relatively small, few years, and the loss has been pretty small until this year. We're already down about 25%. So I don't know what this means necessarily for next year. I'm not trying to make a prognosis for next year, but for you that perhaps are thinking, well, shit, we can't go down for 2 years, or certainly can't go down for 3. Don't bet on it. I mean, it has happened before. And so then I took this page here, and I'm gonna transpose this on top here. What I did was, starting in 1998, if your parents or grandparents gifted you $10,000 in 1998, and you put it all into the S&P 500, and then buy and hold, you never sold any, and you didn't buy any more, where would you be today? So these numbers here, 27%, just correlate to, we start 1998, correlate to the gains I took off this summary over here. So we got 27% the first year, got 20% the next year, and then we, lost 10, lost 13, lost 23, and so on and so forth. And so your original $10,000 that grandma gave you ended up, as of now, would be $33,000. So a gain of 3,300%. That doesn't look right. 3,000. Anyway, more than triple. I got something wrong with that formula. For an average gain per year of 7.1%, which is what, if you go, your investment advisors say over the long haul, the S&P will give you 7, 8, 9%. But there's a lot of pain along the way, years where it drops 38%. Here we're dropping 25%. Here we drop 23% after dropping 13, after dropping 10. So, but still, overall, over a 25-year lifespan, 10, we triple your money. That's not bad, but I think most of us, it works if you're up to about age 40. But if you're older than age 40, we can't, I don't believe we can think in 25-year terms. So we need to do something better. So I just redid the chart, and said, what if the grandma's 10 grand that she gave us, we had an 8% sell rule in effect. So in other words, this is the opening balance on January 1 of how much we had. We started with 10. By the start of the 2000, we had 15,000. But we got out of the market if it dropped by 8% and stayed out until things turned around and we got back in again. We'd have been out all year. And I'm going to say we reset the clock on January 1 again. We start all over and we drop another 8% that year. And this year we dropped another 8%. But overall, where would we be? Well, the 10 grand turns into 78 grand. That's a whole lot better. Just that one simple little rule that says I will not allow the account to go down by 8% from my opening year balance. So then I just took it one step further, take this right out of the way, and said, well, what if we took the 10 grand and the first time it dropped 8%, we sold, and we didn't get back in again until we went positive. So we lost 8% in the third year. But in years 4 and 5, we were completely out of the market. So I don't know when this 8% happened during this year, but for at least 2.5 years, we were completely out of the market, and then got back in again in somewhere in here, we would have got back in again. And what is the results of that? The 10 grand that we started with now becomes 92. So the results are like significantly higher over the long haul with just a very simple get out when the going's bad rule, which is what I've been preaching now for 6-8 months. So you can do your own math on this, but to me, this is an eye opener. It just says that when the market turns against you, just get the hell out of the way and sit in cash and wait for better times. And I think if we followed a very simple, let's take that out of the way, followed a very simple rule of 8%, rather than wait till the beginning of the year, just follow it during the year, the results would even be better. So anyway, that's my little dissertation on that. Nice to be back on video. So hope everybody's staying safe. And the market will turn around one of these days. I think the next move is simply going to be a bear market rally back up into, back up into this area, perhaps up into here, and then roll over again. But who knows? We'll just play the cards as they're dealt. So keep your powder dry and keep studying and keep your watch list up to date. Okay, that's it. See you tomorrow.